Clearly, the market's definitely relieved, definitely seemed to suggest that the CPI number today gave the Fed some more breathing room. Yet we've heard from Fed officials that they need to see multiple months of evidence that inflation is on the decline toward their target. So where does that leave you in terms of the Fed call at this point?
Yeah, Mike, I think that you could call this, one in a row, one good report does not make a trend yet that's going to satisfy the Fed. And look, they're going to talk tough, even though they said they're not going to provide guidance, forward guidance. They're providing forward guidance all the time with these sorts of estimates. But it's going to really depend on the numbers. I think that the Fed continues to raise rates in September, probably more like 50 basis points than 75, because they've already reached that 2.5% level, which they consider neutral, and maybe another 25 or so later in the year, maybe two more 25. But I don't know about, we're hearing 3.5 to 4%, 4% plus by the end of the year. I think that's a really aggressive call on the part of some of the Fed governors. So my guess is that they will slow down before they hit 4%.
Okay, and yeah, if you're suggesting maybe one full percentage point of further hikes over the next few months, that seems to be where the market is comfortable with at this point, right? I mean, trying to handicap that we peak out right there, and the debate then becomes, are they going to be cutting then? What does the economy do in response to what's already been done right now? Do you think that a recession of some description is certainly in the cards or not?
I think there's still a pretty high risk. What we've seen is unwinding of some of the pent-up demand from the pandemic. Now we get into the effect of the rate hikes that we've seen to date. So we've only really just started to feel that slowdown in hiring, the rise in inventories relative to sales. We're seeing consumer spending start to ebb a little bit. The global economy is soft. So I think that there is a risk of recession, whether you call it a technical recession or a real recession, if the Fed continues to be aggressive. And I think that's what you're seeing in the market. The yield curve is steeply inverted, and it's telling you that the more aggressive the Fed is, the less likely we are to have a soft landing and more like a hard landing down the road.
There is that line of thinking that given that stocks are up 15% from their lows, credit spreads have come in, just the absolute yield level is lower than it was not too long ago. Financial conditions are looser, and that essentially replenishes the Fed's budget, if you will, for how much tightening they can do, or they might be willing to do. Does that make sense to you, or are we just going to basically have everything dictated by the inflation data as it comes in?
Well, I think the financial conditions situation is really important to the Fed. And as you pointed out, they've loosened from having been pretty tight. But also keep in mind there's quantitative tightening taking place, and that will pick up steam in September. So it isn't just the rate hikes, but it's also going to be QT that contributes to this sort of shrinking in liquidity in the financial system. So I think that can act as if it's a rate hike. Obviously, the inflation data is super important, and that's what we're all going to be continuing to focus on. But financial conditions is how the Fed transmits its policy to the economy. So if it loosens too much, it may force them to do more. But I think the QT portion of it will serve them in addition to the rate hikes they have planned.
And then just quickly as we go, I mean, do you think that yields have probably peaked and therefore, bonds look like they're decent value at this point?
Yeah, we were suggesting extending duration when 10-year yields got above 3% and up to that 3.5% level. I think that could be a cyclical high, given that we already have a lot of tightening in the system. We have very low break-even rates, this inflation expectations coming down, and we have a pretty soft global economy. So I think bonds are decent here. They were much more attractive 75 basis points ago, but we like, say, investment-grade corporate bonds where you get 4% without taking a lot of duration risk. I think is pretty attractive.
Kathy, thanks very much. Kathy Jones from Charles Schwab.